Gold miners are up, and Kashop is back. So this perfect time to have Kashop on here today, talking about gold miners. Now, gold miners, we've been talking about how long have we been talking about these? It's going back. We've been talking about gold miners. Kashop's been pulling out great picks. I've been talking about the trends in gold, and this has got to go back to before this thing even started. And this is probably a full year, basically. Like, this is a year it started to hit new highs. We've been talking about the new highs being the thing about the new highs that we continue to say is sentiment didn't look right to say, hey, this is a top. Sentiment continued to look like this is the beginning of a new trend. This is going to continue. Yes, people could point out the COT reports and the positioning and the overbought trends because constant chart crimes are going on over and over again in the precious metal space. But the thing that people aren't paying attention to is that sentiment is perfect for a trend starting. I always liked Bruce Kovner's quotes where he talked about the fact that, the best thing that you can see in a market is a trend starting without any news around it. And I think that's incredibly important because we just saw a trend start without any news around it. Nothing really happened to say, hey, I can point to this and this is what boosted gold. Sure, in hindsight, we could say political, geopolitical, whatever. But at the time when the breakout happened, we had no real idea besides, hey, the fundamentals look good. Hey, the technicals are breaking out to the upside. Hey, we've continued to have a continued trend. So, Kashop, what are you seeing in the gold market today? And where's the areas people should be looking for now? Because we'll talk a little bit about the cycle. We saw gold move, then the gold miners, and silver. Now, what do you think is next? Do you think we should be buying the juniors, the silver miners? What are you thinking here?
So I would say the euphoria is good. I mean, the euphoria is only among the people who are watching the space. If you go on Twitter or CNBC, they are still talking about Nvidia and Bitcoin and all the other stuff. MicroStrategy bought some Bitcoin, and that's news. Gold making an all-time high, no one cares. So, but if you look within the community of people who do follow markets and do follow the things that make you money, like gold and the miners, what you're seeing is a little bit of over enthusiasm, little bit of that euphoria, and in my opinion, that's long overdue. Because if you've been in the gold space for any period of time, you had good level of excitement. I can recall the years 2016 around August, September, and then 2020, right when COVID hit, you had that huge move from April to August 2020. And since then, it's kind of been dead. Like you've had these story stocks, the individual stocks that have worked. You've had these great acquisitions which made the news, like Kinross going after Great Bear, or recently you had Goldfields with Osisco Mining. So you had some blockbuster M&A announcements, but other than that, pretty much this. Oh, that's my cat. Okay,
No problem. I
I
have
just
like
hope it does.
all my animals walk in and out. No worries.
So it hates me when I have the laptop on. So
My
yeah,
animals have it's almost like they have a mind of their own. If I'm filming, I used to have my camera was turned a little bit. I had my chair back there. And every single time I had a video, my cat would like lay out on this chair every single time, like it knew it was being filmed. So it's like they're funny like that. And what's interesting,
yeah,
this is an interesting study. I'll end this here before I get on a rant about cats. But there's an interesting
yeah,
study about cats and dogs. And so dogs, when they look at us as people, they see us as people, like we're different from them. Cats just think
yeah,
we are like them. So cats think we're
yeah,
like lazy versions of them who like can't hunt, and so they're always like trying to teach us to do things. That's the reason why they like bring food to us. Like when they catch something in the yard, like they'll come in with like a rat or something, and you'd be like, "Why did you bring that to me?" They're trying to teach us because we're just bad cats. So it's hilarious
yeah.
to kind of think about what they do.
And now it's just drinking from my cup. Let me just lock it up in the bedroom and then I'll come back.
Okay.
Come
Yeah.
say hi. Yeah, you can
Yeah.
just
Go.
say hi on camera.
Hey.
Hello.
Hey. I love cats. I love dogs. I love
Yeah.
animals too much. But yeah, it's very interesting, and also dogs, they found, they did a study and they found out they know a lot more than like what credit we give them. So like when a dog, for example, is like staring at you funny when you say like go outside or something, like they know what that means. They're just trying to be assholes. So it's pretty funny to kind of think about that.
Yeah. So, okay. Where are we? So, yeah, we were talking about the excitement among the gold investors, which, in my opinion, is long overdue. So, good that we are getting there. And there's, when it comes to investing in the juniors, when it comes to actually picking stocks, so there are two ways of going about it. So, you're bullish gold, you buy the futures. You're bullish gold for the long term, you're going to go by the physical because the futures have a roll cost, and the premium that you pay for the physical, you're probably going to end up paying the same thing in the roll cost, like when you roll a couple of times or something. So, in that sense, it's you can go with the futures, you can go with the physical gold, you can go with something like GLD where you don't have a gold roll cost, but you do have a management fee, which is few basis points. It's quite minimal, so you can do that. You can buy the ETFs, so you have GDX, GDXJ, SILJ, like you have your pick of ETFs, and then you can get into the individual stocks. Now, the problem is a lot of people have a macro view and they try to express it by picking individual stocks. And that there is a gap there because when you have a macro view, you want the purest expression of the macro view, and that is in the futures. But if you are looking to get a little more alpha, or you're looking to do something little more long term, and you want to get involved in the sector, then you need to pick stocks. But when you pick stocks, you have to understand that this market is very different from something like technology, because with technology, what do you see? You see a stock. Let's just take Apple as an example. So they have grown from zero in revenue to something like $400 billion in revenue. Now, the growth path is not linear, but overall, it's a trajectory of growth. And that's how they became the most valuable company in the world. Apple, Microsoft, whichever you pick. Whereas if you look at commodity stocks, they are extremely cyclical. They are tied to the price of the metal, and they have a whole host of risks which make them very poor long-term holdings. So even the best managed company, if you hold it for a long enough period of time, you're guaranteed to maybe make 3x, 4x. So I was looking at a study done of all the top performing miners over the last 2 decades. And tech is in the top 10, tech resources. It's one of the best managed companies in the world, and it's done a 6x. That's it. So you really have to time it because these are cyclical stocks. And the value is not always in the stock of the company. The value might be elsewhere. For instance, the value might be in the debt. The value might be in whatever the big companies are acquiring. It could be any number of things. So when you get into the mining stocks, you need to really understand the idiosyncrasies of the space. For instance, I'm just taking B2 Gold as an example because it's been in the news. So B2 Gold, until a couple of days ago, was a stock that gold investors were scared of. Why? Because they were building a mine in Canada up in the Arctic. And that's always a scary proposition because you have all these logistical challenges and, of course, cost overruns. And then they had their biggest mine in Mali, which is an African nation, which is kind of always goes through one coup after another. And it's not politically stable. In fact, the entire region is not politically stable. So you had this company with its biggest mine there, and they enacted a new Mali mining code in 2023. So everyone thought, great, data gold is going to get expropriated much more. And yesterday they came out with a news release saying they had signed a deal with the government and everything is now good, and their benefits, everything is fixed until 2040 or something. And the stock popped 10% on the news. So if you are investing in a stock like B2 Gold, you need to be aware of these nuances. And the problem is, once the stock moves up 10% in a day, if you're looking at it then, you need to evaluate is the market really right in putting the stock up 10% on this news? Because you're betting on a company, you're betting on a country honoring their agreement with the Canadian miner.
Mhm.
And that's the bet that you're taking if you're buying after that pop. Now, as traders, we buy the breakout, and it's as simple as that. As an investor who's doing due diligence as one of the fundamental gold focused funds, these are the questions that they will ask. So, when you see a breakout like this, are they going to confirm it by buying, and are they going to rubber stamp this change and say, yes, the fundamentals have improved and we like the stock now? It may or may not happen. We don't know. But these are the questions that if you are investing in the mining stocks, you should be aware of what goes on behind the scenes. And it's the same with every company. So Newmont announced a great deal wherein they divested a big asset and on very generous terms because they just wanted to get done with it. Now, is this deal good or bad for the stock? When you take a company which is, let's say, a 200 billion market cap company or a 100 billion market cap company, which is followed by 30 analysts and has broad coverage, then the news is always going to be priced in. Meaning, investors are always going to know whether the news is positive or negative because you're going to have commentary from a dozen analysts looking at it from all points of view and giving you that research. Whereas if you have for a gold mining stock, first of all, those analysts don't exist. And that's because after the 2011 commodity top, most of these big investment banks, they divested their commodity desk. So, and of course, who wants to start their career on Wall Street as a 20 something MBA and get into mining stocks? No one, because it's not hot, it's not glamorous. And so this industry has seen declining coverage. In fact, most of the good analysts in this space are over 40, over 50, over 60. And that's just because when they started their careers, for instance, if you started your career in the 70s, gold market was hot. If you started in the 90s, it was a discovery driven cycle. Again, the gold market was hot. If you started in the 2000s, it was hot. If you started anytime in the last decade, you wouldn't be going anywhere near commodities. So it's just this lack of coverage makes a lot of these volatile moves. You really have to evaluate whether from a trading perspective, it's fine. But if you are looking at it from a long term perspective, you really have to evaluate whether the market has the right read on this news. And of course, if you're buying before these breakouts happen, then you really have to evaluate whether there is a shot at outstanding gains because something good is going to happen to the stock. Meaning, if you're priced for the complete bottom, then bad news isn't going to move the stock much lower, and good news is going to move it much higher, which we see in things like volume declining, the Bollinger bandwidth decreasing. So we technicians, we look at things like that. As fundamentalists, you look at other things. But the point I'm making here is that if you go from the ETFs to the individual stocks, you really, really need to know what you're doing because otherwise you're going to get hurt. And this is not something that with experience you can say, I know how to avoid this minefield, I know how to avoid this disaster, because some of these hits are impossible to see coming. So, Ascot Resources, that's a company with a newly producing mine, all of a sudden they just said, we are going to go back to development, we are curtailing mining operations. Now, could you have seen that coming? Maybe, but I don't think so. Same with Victoria Gold. So they announced a massive spill on a heap leach pad. And after the fact, people are saying, yeah, they had poor quality control and that's why it happened. But was the market aware of the quality control issues beforehand? No, it wasn't. So you have the situation where even though you know what you're doing, you still can get hurt. And other example is Panama, not gold related, but First Quantum had its big copper mine in Panama, and that just got closed. Now, could you have seen that coming? Maybe, but not really sure. So you have the situation which makes it very, very difficult to invest in the space. But if we are looking to invest and we are looking for exposure, I would say just keep going down the market cap list. That's the safe way to do it.
That's perfect and good overview of the gold market and how to trade it. So, Kevin, what are you seeing today? And I just got a chart from you. I'll bring it up. Gold futures and treasuries. I like it. So, what are you seeing in the market? What are you seeing in the gold market, and how are you viewing this move in gold, Kevin?
Well, yeah, the gold market, I mean, it continues to rise to the upside. Obviously, we're hitting all-time highs here, Jason, and this is actually probably more of a move than I would have expected. I know that for a fact that this is more than I expected, but I was also under the impression at that time that we would have a stabilization in yields, and we didn't have this kind of readjustment when it came to economic data so quickly, especially on the labor side, right? Now that being the case, kind of looking at, and I get a lot of questions about this. I know you do. I know Shop does this all the time, right? Like, how far can it go? And I don't know. But I will say that if we're looking in the past and we're looking at prior rate hiking cycles or prior rate cutting cycles, there's obviously a very strong and direct correlation between prices of bonds and where gold goes, right? Some of that could also be inherently built in because if you're cutting rates, is it bearish? Is it bullish? You know, usually when you're cutting rates because you want to avoid something, not because we had a soft landing. I believe we've only seen like one soft landing in the early 90s that actually did occur. And so what I'm kind of looking at here is this is the ZN, which is the futures contract for the 10-year future, and then GC, the GC contract, right, which is going to be gold. So what I'm kind of looking at is, all right, we already see that breakout in gold. We know that we've seen a bottom for the most part here when it comes to the 10-year treasury. And now I think they're just going to go hand in hand for the most part here. And this is a 20-year chart. So this goes back quite a ways. And you can kind of see pretty much every kind of cycle within this chart has been met with gold moving higher as the treasury price is now. This is not yields, these are treasury prices moving higher. So that's going to be coming out of the 08 crisis. You see the same thing coming out of, you see the same thing pre-COVID, because people always forget this. Like, we were basically on the verge of a recession before COVID. And that's when we had President Trump at that time, former President Trump, kind of, talk the Fed into cutting rates. And then we just so happen to have COVID like 4 months, 5 months later, right? And so you can see that with COVID, and now you're going to probably see the same type of reaction here. So I don't know where gold can top off at. I wouldn't even give you a price level, but I would just say until that trend changes, or you do see a bottoming when it comes to rates, especially the 2-year, or even if you're looking at the 10-year, or even if you're looking at the 2-year. I like to use the 10-year because everybody kind of focuses on it, even though the 2-year is probably going to be more in focus here in the near term. So that's why I brought that chart up.
No, I love it.
Yeah.
And I also like the idea of when you look at the market in 2019, like, Kashop and I were talking a lot at this point, and we were looking at this kind of like stagflationary market that we were seeing building. This is before COVID even happened. So you kind of had a run in oil that happened towards the year end. You had gold start to move higher. That started in May, getting all the way into the year end, and then into basically February of 2020. So you had all these kind of interesting things kind of happening back then, and we were definitely headed into recession already. And then COVID absolutely just sped it up, and there
Well,
we
they
are.
bailed them out. They bailed everybody out too, right? Because
Yep.
without COVID, I don't think we would have had the fiscal spending like we did. And I know people get very upset with that, but
It's
when you
true.
have an unforeseen event, something that it comes literally once in a century, if that, and you don't know the impact that it could actually have on human lives, you're going to spend your way out of it. So they did the right thing, but that actually probably helped because it wasn't looking really too good. It seemed like the Fed was going to actually stand their ground when it came to the rate policy, even though the politics didn't really appreciate it.
Yeah,
So
I
I
mean,
think
go ahead.
yeah,
Go ahead.
even before the COVID hit, I think the market was kind of pricing in the recession.
Mhm.
It's just that dynamics completely changed with the Fed increased the money supply by $3 trillion within a month, which is a scary amount to think about. And that just changed everything. And I think if that had not happened, we would have had a recession back then, and probably that would have been healthy because by that point we hadn't had a recession since the 2008 crash. So you had 2011 to 13, the S&P was weak, market was kind of weak, but even then the US was considered the cleanest shirt in the dirty laundry. So a good crash or a good correction at that point, I think would have been very healthy. And I think probably that's delayed, and that's what we are seeing in the data now with unemployment starting to tick up and the job loss is kind of picking up. But I don't know, there's just
Okay.
something I'm sure you have a different opinion.
Yeah, I'm gonna push back on. No, I love your opinion. I mean, this is good, right? We have these kind of conversations. I would say the setup at the time, and I'm gonna go revert back to commodities, right? So I'm not even let's X out the equity market at that point. I think that's kind of that maybe the route that we were going as far as tariff policies and trade wars going into a recession, though, was a little bit concerning for me, because that would have created, if we would have saw some real follow through, that would have created, in my opinion, a stagflationary market, because we were basically on the verge of completely resetting supply lines and logistic lines, especially when it comes to China, right? Which I don't think a lot of companies were really prepared for. And I think people kind of like forget that a lot of policy was posted on Twitter and created havoc when it came to the commodity space, right? Announcing that trade war on Twitter created havoc when it came to the grain markets. A lot of people forget grain markets were probably the most vol that I've seen in a very long time. I think, and this sounds really horrible to say, but I think COVID and us being able to not have that direct reliance on those trade lines, because obviously consumption for a lot of goods went down synthetically. And then we had this whole reset when it came to not only policy or the direction of policy that we were moving forward, but also when it came to spending and things of that nature. I don't know. That's just me. Now, I hate kind of bringing that up because it has a political element to it. And if you're an equity trader, completely disregard what I'm kind of talking about here, right? But from a commodity standpoint, it was getting real iffy there for pretty much all products out there. It was getting really iffy. So I'm kind of glad that we were able to avoid that and actually focus on something else that took precedent, because the fallout of that, these trade deals, and we had a grain commitment that China was going to buy all this grain from us. They bought literally probably all 15% of that overall commitment. They didn't follow through. I mean, there's a lot that actually changed with that whole scenario of pre-COVID in that recessionary environment. But it's in the past now, I guess. Well, I guess it's not in the past, right? I mean, we might be getting two birds with one stone here. And actually, I don't believe in a Goldilocks scenario. People know that. Like, if you literally watch me or listen to me on Spaces or whatever, I do not believe that Goldilocks scenarios occur. In the 90s, I believe it was a little bit different because housing was a little bit different back then, right? Housing is like god awful right now when it comes to supply, and so we're going to be kind of we're going to be treading new territory when it comes to rate cuts, and then how does that actually impact existing home inventories, and is that going to be inflationary, or are you going to see this complete opposite of what the norms would tell us, right? And we see this complete flood of inventory hitting the market as people try to get out, move up, or even move and size down, right? So I don't think.
So there's
go ahead.
Yeah, so there's actually a theory floating around that once the Fed lowers rates, a lot of people who are stuck with their 2%, 3% mortgages, they're going to be able to finally put their house up for sale and move on. And that's going to unlock a big amount of supply, which the market is not pricing in. Now, I don't live in the US, so I don't know if this theory has any validity. I heard it from a friend who is in North Carolina, where he said this is exactly his situation. What are your thoughts on that?
Yeah, no, that is a theory. So if you ask me what's going to happen with housing right now, I would tell you that I do not know. And that's a perfectly fine answer, because that theory is something that in the back of my mind could actually happen. I don't know if it's going to happen, because if you're looking at the amount of individuals that have mortgages below 3% or even 3.25%, that's the bulk of the overall population or new home buyers that we've seen over the last, 20 years, 15 years, right? So it makes it very difficult for us to have those rates going back down to those levels. And if we did, then we have a problem in general, right? But maybe, I don't know. I look at it, I mean, for me personally, I care less. I mean, if I see a 5 handle on a rate, I have a rate that's 65, 70% better than that. I'm not going anywhere. But I don't know. There is a theory that out there that has that, and that might be the case, Kashab. The other side of that coin, though, right? Let's just walk this through. And what we're talking about is rates being cut, mortgage rates going down. It's just going to unleash a lot of those individuals that have existing homes and say, okay, now they're a little bit more competitive. And maybe, and I don't know, maybe I'm willing to take on a higher rate because the demand for me to get into a new house is now equitable for that rate or that increase in risk that I'm going to be taking. Or maybe I'm willing to get that higher rate because I need to downsize, right? We're also talking about a whole population of boomers that have very low rates as well. Although those individuals that just bought houses over the last 20 years or so, and maybe some of them still have adjustable rate mortgages or ARMs, which is a smaller population right now. It's not as popular, but there's still a lot of individuals that are out there. And if boomers have ARMs on their adjustable rate mortgages, and they're going into retirement or have retired, then what are they going to do, right? Are they going to size up or are they going to size down? That's another quick question. The other side of that, in my opinion, and I think you're seeing that right now, because mortgage rates have already come down pretty good. If you're talking about high level to where we're at right now, I believe what was like a last week. I mean, we saw 20 basis point adjustment in mortgage rates in just a week. Mortgage rates applications went up 1.65%. That tells you something. 20 basis points. I mean, you got my mother was a loan officer. 20 basis points is enough to spike some applications. You ain't seen it. So did also individuals that were trying to buy homes, especially first-time home buyers that just saved up equity and had the equity ready to go when we had low rates, but were priced out because of higher rates, did those individuals also burn their capital to be able to maintain a higher inflation environment? No one's talking about that, but we don't know. We don't know what that whole situation could be. Could we also see a situation where individuals have the cash, we cut rates, boom, there's a huge buying spree taking place. Maybe existing inventory comes in, but it doesn't meet the actual demand that's out there, and prices spike to the upside again. There goes your shelter component. There goes your owner's equivalent rent, and you'll never get that down. Well, it'll be a new cycle. And if that new cycle then takes place, you're not getting back down to 2%. You don't get back down to 2%, inflation stays elevated, wages maybe stall out. What do you got? What do we call that? And let's say growth stalls out. What do we call that? Stagflation, right? I don't know. This is a completely new environment. I'm leaning more of the case that I don't think people are going to leave, or I don't think you're going to see in a massive amounts of existing homes coming online because an interest rate goes down to 5% when somebody holds a 2 3/4 rate mortgage. That's me. Because if they are, then they either save their capital, really good, right? Equity performance could have helped out with that, or maybe they're going to be downsizing. But I can tell you, I have houses on my block right now. I have a house that's on my block right now. This is absolutely how ridiculous this correction is happening. I'm going to put the whole business out there, right? But it's online. You can see it. All right. So these individuals, they bought a house. They had it built, right? We were going on our 3rd year. So we bought this house new. Our whole neighborhood is new. They bought this house for $640,000. Not this house, but this house down the street. A neighbor. $650,000, give or take, right? $640,000, something like that. They put their house out on the market 6 months ago. They wanted $1 million. Now, granted, they put some money into their home, not $1 million worth. So the house sat. And in my neighborhood, we would have houses go up, 8 months ago, 9 months ago, we would have houses go up and people would sell those houses in 2 days, 3 days. It was crazy, the turnover. Okay, nobody's buying the house. It's been on the market for like 6 months. They cut the price. They cut the price to $865,000. still on the market, right? You just burned $200,000 worth of a price cut to try to get rid of this house, and you're still trying to sell it for over 200,000, 250,000 from what you bought it for in 2 years ago. The return on investment would be remarkable if they're able to do it. And if they are, you gonna see a for sale sign on my house? Maybe, because I'll take that equity and buy something in a different state. But that just goes to show that the housing market, and I live in a very high demand area, used to be, is starting to slow down. And prices are starting to get cut. But even when you have an aggressive cut, you guys are, I just explained literally a 20% cut on a house that was put up, and it's still not going. Right? We're coming back down to reality here. I feel like, I don't know. I feel like I'm half and half with it. I would be very shocked if we cut rates and we see an increase in supply and you actually start seeing prices stabilize and go down for housing. And if that's the case, that's a whole new, we are going to be writing articles and research papers and thesis about that for the rest of our lives, because it's something that we've never experienced before.
No, I like that. It's a big picture view. And I think that's the thing that I'm kind of seeing too, is like the big picture view for me is, there's two things. One is like, this is very similar, and it's kind of crazy we're talking about this because I can remember a very similar conversation in 2019 about this same kind of thing. We're kind of looking at stagflation building. The question is, how much money is there in the world? That's the biggest thing that I think I continue to kind of wrestle with. How much money is really out there? Is everybody really hurting like they say, or people just loading up on savings, ready to buy? There's just a bunch of ways to look at this at the moment. I think it's incredibly interesting. But I also kind of lead towards a stagflation at some point. Is it today? No, not at all. But at some point, I think that could happen.
Yeah, well, I would say both of those notions are right? There's a cohort of consumers that are doing just fine. And there's a cohort that is not doing great, and they haven't been doing great, and it gets worse and worse for them. Ally Financial is a really great example this week. Now they have auto loan exposure. They used to have actually consumer loan exposure, a lot of it. They sold that to Synchrony, which, keep your eye out, because somebody else bought their loan book. That might be risk on their own portfolio, right? But we'll X that out. Ally came out this week and was like, yeah, we're seeing credit weakness. We're seeing individuals that have difficulties paying down their credit for their auto loans. Auto loans are usually kind of the first ones in that first sign. But Ally is not the first one to experience this. Capital One has been experiencing this for last year. Their domestic charge-off rates for Capital One is also still fairly high. They're still in the 6% if you're looking at a month-over-month basis. 6% for net charge-off rates for domestic credit cards. That means here in the United States. Let me put that into perspective. For every $100 that they're putting out there in the marketplace right now, they're burning $6 of that is just getting burned. Usually that's sitting at 2.5%. And it stalled out, but it was climbing at a very rapid rate. I mean, like if you go through their earnings announcements over the last year, once again, it was 2.5 or 2.35, going up to 6%. That's remarkable. That's a remarkable change. So I think we have to be mindful of that. I mean, that's a huge crash burn. I mean, that actually does have an impact. Now, the thing that's benefited them is two things. There's ways to be able to engineer, and I have to jump after this. There's a way for credit card companies and lenders to be able to engineer quality on their books. All right. Discover is doing this. I know that for a fact. Capital One is doing this. You hit a threshold of 50% utilization rates when it comes to credit cards, right? Usually at that point in time, that's when credit starts to look iffy. Not, iffy, right? Whatever. But if you increase the credit balances on that, the credit availability on that same portfolio, you can knock that thing down and make it look good. If I have $10,000 and I spend 5,000 of it, I have a 50% credit utilization rate, right? 5,000 divided by 10, or 10,000 divided by, right, 50%. They could say, okay, well, man, this individual is actually spending a lot of money. We need to tighten this credit line up. And typically that's probably what they would do. Or we'll increase this credit line by $5,000. So now my credit line's $5,000 or $15,000. I have 5,000 that's being utilized. What's that rate? 30%, right? That's a way that you can do it. And you pray and you hope that that individual does not capitalize and actually use that credit. Because if they do, guess what you have to do again? You either have to chop their credit quality down, which is going to impact your financials when everybody's looking at them, or you got to extend them more credit. That's a problem. And I think that's exactly what's been going on. And now we're seeing kind of the tail end of that. Affirm is another great example. People love Affirm. The stock, I can tell you right now, the financials for Affirm, from what I see, does not add up. Okay. And one day, I'm not saying it's tomorrow, one day there is going to be a problem there. Affirm has a lower net charge-off rate than American Express. Affirm, a company that does not even check for certain items your credit quality at all. Right? A company that is allowing individuals to finance grocery payments. Okay? Tell me how they have a lower net charge-off rate on their books than American Express, which has the highest quality rating of credit for major for the major population of consumers, right? They have the best credit quality. American Express sitting at around what, 2.25% to 2.75% net charge-off rates. If you look at Affirm's net charge-off rates, not this quarter because I don't have that number offhand, but the quarter before that, 0.75% net charge-off rates. Tell me that makes sense.
So I think the circling back, it comes down to the fact that all of these companies are marking to model. And when you mark to model, you do have that kind of leeway to not exactly manipulate, but you can make your numbers look better or worse on a quarter to quarter basis.
Mhm.
And that's kind of seems to be what's happening. And look, like all of this may just blow over. The Fed cuts 50 basis points, credit grows, the economy recovers on track, and whatever model that they are using, what everyone is using, may just turn out to be just fine. Or you may have the flip side where the market cracks, we get a mild recession, and then the charge of rates, all these models, everyone starts looking at it a little more closely. And just to build on what you said, I think it's the same problem with the private equity space where we are seeing these companies continue to attract assets. At the same time, there are so many examples of different marks on the same investment by different firms and different funds. And it just all ties back to the fact that you're marking to model, you're not exactly marking to a market price because there's no liquid price there. So you get to have a certain amount of leeway with the numbers. And where this ends up, I think it all comes back to what the Fed does and how it impacts the economy. You don't
Yeah.
get a recession, things recover, everything is great. And if you do get a recession, then you just don't know what's going to happen. And I think we should keep our eye on Affirm, Sophie, Ally, all these firms, because that's pretty much where the market is going to be pricing in the marginal impact of the rate cuts.
Yeah. I do have to jump real quick though. In every single economic downturn, recession, depression, what have you, what was the catalyst? It's credit. So until credit spreads widen out, until credit availability gets tougher and tougher, no one's going to care about you, what you and I are talking about, even though they should. They should care. Somebody should care that a firm that caters to, and nothing against it. If you use a firm, by all means. Actually, I used a firm once just because I wanted to see what the experience was like. Cool. But if you tell me that a firm has a better net charge-off rate and American Express, you got another thing coming. It's a problem, but it won't be realized until actually credit does contract. And right now we don't have that happening. No one's going to care about anything until that lending dollar starts to contract. We can even have stagflation, but people may not care. They may not care as long as they have the availability and liquidity of credit. And until that changes, all of this stuff that we're talking is really good theory. And I love these exercises. And I think it's really good for people to actually understand them and know if there's outsized risks out there in certain pockets of the market. Just because it doesn't give you your bull thesis or something that doesn't directly relate to alpha in some stock or some blah, blah, blah. I know people get pissed off about that, but it's like, you still need to know. Knowledge is power. And then it also does provide you an opportunity. If you start seeing credit lines starting to dry up a little bit, spreads starting to widen out, boom. Then that offers you, okay, maybe there might be a couple of targets out there that I can hit. But I do have to jet. Hey, Jason, I had the wheat, you called it, good pop.
It's moving.
Looks like it's fading in a little bit, but it's on an intraday basis. But good call there. Looking for next. We'll talk offline.
And also Monday, we'll talk about natural gas too. So we had a great move in natural gas. Kevin called that out as well. Like we have a trade on in it. It's been working out really well, but we'll see you guys on Monday on the commodity report at 11 Eastern time.
Take your money and run. Okay. See you guys.
All right. Later, guys.
Bye.
Okay, Kashop. So basically what we're seeing here, and I think he's right, we're looking at credit. And I think that's the thing, like I write about bonds all the time. I know people get bored out of their fucking minds when we're talking about bonds. And I understand it. Like, yes, they can be boring at times. Yes, there's not a ton going on every single day. But if you want to understand macro, you want to understand the landscape, and if you want to make money, you got to understand the bond market. And you got to understand the credit market and what's going on in the world. To me, there's not a better indicator of where we're headed. Credit, what we're talking about in 2019, liquidity was dry as a bone. It was started to dry up in late 2019. And then getting into they started to cut rates back in, it was August. They had that little, it wasn't really a crash, but the market got all chopped up in it and everybody was panicked in August. And then they had the reverse repo scare. And then they came in, they started to cut rates, they started to add liquidity, but not fast enough. That was the thing. It wasn't really fast enough to really do enough to the market to get us out of a recession. Then next thing you know, and this is why I always say, it's not just like looking at the fundamentals, knowing the future and thinking you can understand what the market's going to do. If you would have looked forward in hindsight and said in 2019, there's going to be all this liquidity pushed into the market. We're all going to be using Amazon because we're all going to be stuck in our homes in the United States. Some people would have been like, that's crazy. Let's buy everything in Amazon. We're going to be millionaires, billionaires, and thinking that the market probably wouldn't have came down that way. Other people would have thought the market's going to be down for the next 20 years. They shut down the economy. Really, all we got was a fast crash. So it's the reason why, like, the fundamentals absolutely matter. We have to understand what's going on in the world, but understanding liquidity is going to tell you where we're at. If you understood the liquidity was low, and then once we saw that crash happen, liquidity low, crash happens, Fed jumps in, unlimited QE. Basically, the market was in free fall. They cut rates to zero and so on. Finally, they said unlimited QE and the market started to go back up again. If you understood those facts, you could possibly front run that. But if you don't understand it, you're the person thinking you're getting a great deal when the market's down 5%. You think you're getting a great deal when it's down 10%, down 20%. And most of us were sitting here going like, I know Kashop and I were like, I don't know when this ends. Like really, like we had no idea where that ended until something came in and said, hey, we're going to add this much liquidity to the market. And that's when you get the bounce. And that's also how it created the commodity thesis and more. So it's a very interesting idea.
Yeah. And on the other hand, it's not as straightforward because I know a lot of viewers will look at what you said and just take this simplistic notion that money printer go bir, buy everything. And it's not as simple as that. At one point of time, that absolutely works. But if you look at what happened in 2008, the Fed cut rates and market bottomed 6 months later. So you do have this lag period. And again, it's all about really studying different cycles, preparing yourself for different scenarios of what could happen, what has happened in the past, and then based on that, all you can do is generate a hypothesis. It works, you press. It doesn't work, you just cut your losses and move on, because that's really what macro is. Like, a lot of people see movies like The Big Short and think, oh, you have this idea, it has to work. And for every big shot, there are 10 different macro ideas which sound just as good, which hasn't worked. Like, off the top of my head, people shorting the Hong Kong dollar, people shorting the Saudi riyal, people saying the pegged currencies have to collapse. Didn't happen. So you can add negative rates. Can anyone imagine that rates can go negative? But if you had shorted bonds when I think it was Bill Gross who said German bonds are the short of a lifetime because rates were at zero and those went negative. So you just cannot imagine the kind of macro scenarios that will turn up. Or when the Swiss franc broke its peg to the euro, all the brokers, all the FX brokers allowed max leverage on that pair because they thought it's pegged. And when it turned out not to be true, quite a few brokers went under. So you always have these risks, and it's never as simplistic as money printer go bir. You just buy everything and it works. Sometimes it does, sometimes it doesn't. And I think that's the most important takeaway when we are talking about macro.
Yes, and I mean, even think of Jim Lightner is a great one. Jim Lightner coming in and being like, "Hey, I'm going to buy call options, hoping that bonds go to zero," and people thought he was nuts. You know, he bought call options at 100, and people thought he was just losing his mind. But once again, that's how the markets work, and I like how you said that. Like sometimes you press, and I think that's the one thing that I don't know if I'm the best trader in all these ways. I think too many people think of it like I'm great at this. I'm great at this. I don't know what I'm great at. I know that I follow my strategy. I follow it well, but part of that strategy is pressing at certain times. I had a conversation the other day, like, can you be irresponsibly long as a systematic trend follower or a macro trader? And the answer is yes. Like you get irresponsible. For example, right now, I would say that we're irresponsibly long bonds. Because we're long across the curve, where every single thing has a buy signal from the 3-month all the way to the 30-year. So we're long all of those. But that's the times where we make major returns. Major returns are made when you start to press these things. But once again, you also have to have that ability to just go, I'm wrong, and get out. So it's the Peter Brand always would say it, strong opinions weakly held. I think that's macro 101. You have a very strong opinion. Hey, these bonds are going to have, for me, it's a corrective bounce. I don't think bonds are going to go into a structural bull market. I think bonds at some point are going to go back down again. But right now we're long bonds. And I'm thinking, okay, right now we're getting hype. There's a story behind the rate cuts and so on. Put that all together with all the rest of the trades that are out there that we're getting signals in, and you've got gold, you've got silver, you got palladium moving. It all makes sense for a rate cutting cycle. But the second this starts to go the other direction, and I start to see, let's say, oil starts to break 70, 80, and we start to see bonds start to move the other direction, I get sell signals on bonds. This is when this will all change, and I'll go, well, I'm wrong. And I think that's the most important thing that we're saying here today is we really like the idea of gold, but you wouldn't see Kashop and I getting on here telling you that gold is awesome and the miners and so on and talking about all these things when they start to go against us. There was a good one that's brought up the other day by George, and I was reading Hedge Fund Market Wizards again. I've read that so many times, but he talks about Col Moshe. And Col Moshe, when George Soros has his, he had this huge thesis on something. I forget what it was, but he has this huge thesis, and he goes on TV, he talks about it. He talks about it like it's the most conviction he's ever had in a trade in his entire life. And then he gets back into his firm, and he looks at the price action, it breaks a level, and he goes, I'm out, and he's done. And that's the end of that trade. And I think that's really like kind of the way you have to be. I think traders that are new think it's like, oh, you don't have any conviction, you're wishy-washy, got to have conviction to make money. Analysts can have conviction. Like I can write something and have entirely a ton of conviction in it, tell you that it's going to new highs and that the world's going to be a beautiful place forever. But as a trader, if I call all of my clients and I go, hey guys, I want to tell you that I have full conviction in this trade and it keeps going against me and I'm losing all their money and I blow up all their accounts, they're not going to be like, man, at least he had that conviction. I respect his conviction. They're going to be like, I lost all my money with this guy, F this guy, and so on. So it's an interesting idea here, which is, have those strong opinions, but be willing to just say I'm wrong because you're going to be wrong a lot as a trader. I think the best thing I do is try to get the environment right. If I get the environment right, I'm gonna be right a little bit more. That's about it. But yeah, I gotta get going in a sec. Kashop, do you have anything to add real quick before we get going?
No, I think we covered pretty much everything. Oh, not to put you on the spot, but one question. So, if you're following what's happening with Canada and China, you have this trade war going on because of the tariffs.
Mm-hmm.
So what are your thoughts on how this impacts canola?
Man, I don't know. Canola's been a short for a long time. We've been shorted for a long time now, and it's tough when you look at that market because there's so many things to do with vegetable oils. Vegetable oils are incredibly hard to trade because they trend so hard one direction and the other. It's very easy to put on a systematic trade and just be. So let me say this a little better way. It's easy to put on a systematic trade where you're looking at breakouts, you're using a very wide stop, and you're hanging on for a long-term trend. But trying to find the fundamentals behind it and how they will handle the vegetable oils like canola oil, soybean oil, and make the market move, I'm not sure. I've never gotten it over the years. I've tried to figure it out. I've tried to build models that are fundamental, like my corn models, my wheat models. These things make sense to me, and usually the market bottoms around these times. But canola oil, soybean oil, there's so many political things behind it. There's movements that end up happening that move in certain directions. There's companies that blow up. There's the spread, the crush. There's just so many things behind it. But for now, I think that canola is in a nasty downtrend. I think canola, though, is in an area where it's very cheap. So for once, it's in a scenario where anything that would put pressure on it could lead it to an upside move. But I would watch soybean oil, canola before I take that trade. So I'm continuing to be short it. I think it's a good idea to just continue to be shorted at the moment and not overthink it. But it's very interesting times we're living in because of the election and the tariffs and everything that everybody's talking about. There's so many interesting things happening, but I think the grains are kind of showing wheat is starting to move. We're also seeing this thing with gold and silver and palladium. If we're looking at all of these things and all of these different areas right now, we're seeing that there's trades building. And I think that's very similar to all the other election seasons. Like if you go back to 2020, there was Bitcoin started to move and people were like, why is that moving right now? And this was before the election. Then we saw the grains start to move. Then we saw sugar. Then we saw some of these things start to move as well. And then the election happened and things exploded. So I think it's going to be very interesting to trade commodities through this election cycle. I think there's going to be a lot of money made on the long side and the short side.
Yeah, I think that's a perfect note to wrap this up.
Cool. All right, guys. Thank you for joining us. We're on Fridays at 11 a.m. Also on Mondays at 11 a.m. on the Commodity Report. We'll see you guys soon.